Something just happened in the silver market that the financial channels are calling a milestone, a breakout, a brand new high. And I want you to be very careful with that word because it is doing a lot of quiet work. And most of the people saying it either do not understand what it hides or they would rather you did not ask. The headline is designed to make you feel like you missed something. I am going to show you why the opposite may be true. If you are holding silver right now, or you have been sitting on the sidelines, wondering whether the whole move has already passed you by, this matters directly to you and to your retirement. Because the story you are being sold about this so-called record is not the whole story, not even close. By the time we are done here, you are going to understand what a real high actually is, why the one everyone is celebrating is a kind of illusion, and why the mountain that matters may still be standing in front of us rather than behind us. Here is the appetizer, the one fact I want you chewing on before we go any deeper. The number everyone points to as silver's all-time peak, the level that stood for a generation, was set back in 1980. And in the years since, that same round number has been touched again, tested again, and talked about as a ceiling again. But a dollar in 1980 and a dollar today are not the same dollar, not remotely. When you adjust that old peak for everything the dollar has lost in the decades since, the true high, the real high, sits far above the number on the screen. And here is the part that stops people cold. In real terms, adjusted for what money is actually worth, silver has never reclaimed that peak. Not once. Not in the 1980s, not in 2011, not now. Let me say that again slowly, because the big banks and the trading desks are counting on you not thinking it through. A new nominal high is not a new real high. The screen can print a bigger number while you are actually further from the true summit than a saver was more than 40 years ago. That gap between the number they show you and the value they hide is the entire subject of this video. Now, before I go further, let me tell you who I am and who I am not. I am not here to sell you a fantasy or a price target with a date on it. I have spent a long career sitting across the kitchen table from people just like you, folks in their late 50s, their 60s, their 70s, with 100,000, 200,000, sometimes far more, built up over a lifetime of work inside a 401k or an IRA. And what I have learned is that the people who get hurt in markets are almost never the ones who understood what they owned. They are the ones who got a headline instead of an education. So let me give you the education. Go back with me to 1980 for a moment, because this is the real story the whole thing rests on. Silver ran to a peak near $50 an ounce. It was a genuine mania, a frenzy. Ordinary people lining up outside coin shops, families pulling the silverware out of the cabinet to sell it. A whole country suddenly convinced this was the thing. And then it broke, hard and fast, the way manias always do. For most people watching, that $50 number became a kind of tombstone, the high watermark, the level silver could never get back to. And they were half right. The nominal number came back around once more, decades later, in the spring of 2011, brushing up against that same old ceiling near 50. 2 times in about 31 years, silver kissed that number and fell away. A ceiling roughly 3 decades wide, sitting on a base that is now something like 45 years long. But here is what almost nobody stops to calculate, and it is the heart of everything. That 1980 peak, measured in today's money, was not $50. It was worth a great deal more, well into the low 3 figures in the dollars you spend now. Think about what that means. A machinist who bought silver near the top in 1980, in terms of real purchasing power, paid a price this market has not seen again in more than 4 decades. The screen tells you silver is at an all-time high. The arithmetic tells you that in the only terms that actually matter, what your money can buy, silver is still climbing toward a peak it set before some of you had gray hair. The record they are cheering is a nominal mirage. The real record is a mountain still ahead of us. And this is exactly the kind of thing the big banks and the financial media have no incentive to explain to you. Think about who benefits when you believe the top is already in. A frightened holder who thinks he missed the move is a holder who sells. A saver who believes the record is behind him is a saver who does not accumulate. The trading desks make their living on your churn, on your fear, on you handing the metal into a dip because a headline told you the party was over. The silence about that inflation-adjusted high is not an accident. It is a business model. Let me take a breath here and speak to you directly. because this is the moment it becomes personal. If everything I just said is true, and it is verifiable history, not opinion, then the real risk to your retirement is not that you buy silver near a top. The real risk is that you get scared out of it near what is, in real terms, still the foothills. And that fear is manufactured. It is manufactured by people who profit when you act on emotion instead of understanding. So let me pause for one important thing, because this is the point in the story where it becomes practical. You have probably heard that central banks, the most sophisticated, best-informed buyers on the planet, have been accumulating gold at a record pace, more than 1,000 tons a year for 3 straight years, roughly double what they bought the decade before. They are quietly moving out of paper promises and into metal they can hold in their own vault. Here is what almost no one tells the ordinary retiree. There is a perfectly legal, long-established way for you to do the very same thing inside the retirement account you already have. You can move a portion of that 401k or IRA into physical gold and physical silver, real metal, without triggering taxes and without triggering penalties, through what is called a self-directed precious metals IRA. I put together a free retirement protection guide that walks through exactly how it works, in plain English. And this is not some insider club. If you have $100,000 or more in any retirement account, this is squarely for you. If you are watching this on your television, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. Take a look, and then come right back, because the next part is where this really opens up. All right, let me show you why that inflation-adjusted gap is not just a piece of trivia, but a structural signal, by stacking up what is actually happening underneath the price. Because here is the part that changes things, and almost nobody on the mainstream channels will walk you through it. Start with the metal itself, the physical reality. Silver has been running a supply deficit for years now, several years in a row, where the world uses more than it digs up and refines. And unlike gold, which is hoarded, treasured, locked away in vaults where nearly every ounce ever mined still exists, silver gets consumed. It goes into solar panels, into electronics, into electric vehicles, into 1,000 industrial uses in tiny amounts, dispersed so thinly across each device that recovering it is often uneconomic. Gold is hoarded. Silver is burned. Every year of deficit draws down the above-ground stockpile a little further, and that inventory does not come back. That is a very different foundation than 1980, when the frenzy was pure speculation with nothing structural beneath it. Now layer on what the price actually did recently, because it matters for how you read this moment. Silver climbed to a fresh nominal high, and then it went through a sharp, deep pullback, the kind that shakes the confidence right out of people. It fell back toward the very zone it had broken out from, and it sat there, chopping, getting tested again and again over months. And here is the tell that the financial media glossed right over. Through a good part of that shakeout, gold held. Gold barely moved while silver did the heavy swinging. And when silver falls while gold holds, silver has just gotten cheaper relative to gold than it already was. The ratio between them widened, which is a fancy way of saying the discount on silver deepened. And then, more recently, that ratio began to compress again as silver started to firm and outpace gold, an early sign that the physical and industrial buyers were quietly stepping back in while everyone else was busy being afraid. You have to understand how these shakeouts get engineered, because it has happened before in ways that had nothing to do with the metal. Think back to 2011, when silver was pushing against that old ceiling. The exchange that governs the paper market raised the margin requirements, the amount of money a trader had to put up to hold a position, and raised it again in quick succession, and silver fell something like 30% in a matter of days. Now, listen to me carefully. Nothing about actual silver changed in those days. Not one solar panel unbuilt, not 1 ounce of new supply discovered. The rules of the paper game changed, and the paper game dragged the price of real metal down with it. That is the world you are investing in. One where the people who write the rules of the exchange can reshape the price of your metal overnight, and where they tend to do it right when a rally is threatening to get away from them. And it is not only margin rules. The paper world has shown its hand again and again. There have been episodes where an exchange simply canceled completed trades when the paper side was losing badly to the physical side, unwinding done deals because the metal did not cooperate. There have been squeezes that fizzled because people bought paper claims instead of real metal, and buying more paper claims just manufactures more paper, which is exactly what the desks want you to do. The lesson underneath all of it is the one the big banks least want a retiree to internalize. Paper is where they set the price. Metal is where the value actually lives. And the two can come apart, sometimes violently. And when they do, it is the person holding the real thing, in his own name who sleeps at night. Now, let me pull the lens back, because there is a bigger reason that inflation-adjusted gap keeps widening, and it lives in the world of the dollar itself. For a long time, there was an iron rule that every trader learned early. When real interest rates rose, when money paid you more just to sit still, gold and silver were supposed to fall, because metal pays no interest. That rule held for decades. And then, in recent years, it quietly broke. Real yields stayed high, and gold climbed anyway, to record after record, defying the old relationship completely. When a relationship that reliable snaps, it is telling you something has changed underneath the surface. And what changed is who is buying and why. It is central banks and physical buyers reaching for metal not as a trade, but as a place to stand that no one else controls. Consider why that urge got stronger. After one major nation watched its foreign currency reserves frozen by the countries that held them, every other central bank on Earth absorbed a simple, chilling lesson. A promise held in someone else's system can be switched off. Gold sitting in your own vault cannot be frozen by anyone. That is not politics. That is just the plain mechanics of who controls what. And it is the same logic that makes physical metal in your own name different in kind from a paper claim you merely hope to collect on. And that matters right now, because the money world just got a jolt from the top. The Federal Reserve came under new leadership, and the markets had talked themselves into expecting a gentle rate-cutting hand. What they got instead was a distinctly harder line on inflation, and that surprise rattled the metals, gold and silver both, and helped drive the sharp correction I described. Here's the thing to hold on to. A hawkish surprise from a central banker can absolutely shake the price of metal for weeks or months. What it cannot do is unbuild the solar panels, refill the drawn-down inventories, or reverse years of supply deficits. It moves the screen. It does not move the structure. And the people who sell you the screen are counting on you confusing the two. This is why the enemy in this story is not really volatility. Volatility is just weather. The enemy is the narrative machine that uses the weather to separate you from your metal at the worst possible moment. When silver ran to that nominal high, the same voices that now call it a record were the ones stoking the euphoria near the top. When it pulled back hard, those same voices whispered that the bull market was over, that you should be relieved to get out. Up or down, the message is always calibrated to move your metal from your hands into stronger ones. And the one fact that would inoculate you against all of it, that the real high is still ahead, is the one fact they leave on the cutting room floor. Now, let me be honest with you, the way I would be if you were sitting across from me, because you deserve the caution as much as the case. Nothing I have said is a promise of a price or a date. Silver is volatile, genuinely, stomach-churningly volatile, more so than gold, and it can fall hard and stay down longer than you would think possible. This is a case built on history and structure, not a guarantee, and it is not personal financial advice for your specific situation. So how should a sensible person near or in retirement actually think about it? A few principles. Own the metal, not a paper promise. Real gold and silver you or your custodian actually hold, not a claim on someone else's obligation. Size the position so that a sharp drop, and there will be sharp drops, can never force you to sell, because forced selling into a shakeout is exactly how ordinary people turn a temporary decline into a permanent loss. And when the fear comes, and it will come, do not sell into the very shakeout that was engineered to make you sell. Those three ideas will protect you from most of the damage people do to themselves. And here's the part one most want you to sit with, because it is the difference between the people who look back with regret and the people who look back with quiet satisfaction. Right now, you are early. The smart money, the central banks, the sophisticated allocators, they already see what that inflation-adjusted gap is telling them, and they are already positioned, quietly, without a press release. The mainstream has not caught on. The pension committees, the financial talking heads, the neighbor who thinks a savings account is a strategy, they are still calling the nominal number a record and moving on. But by the time this becomes obvious to everyone, by the time it leaves the evening business segment and every advisor in the country is recommending it, the easy part of the move will already be behind us. That is how it always works. The invitation never comes. Nobody is going to call you and tell you the window is open. By the time it is obvious, it is late. Which brings me back to where we started, and to the honest answer to the question in the title. Did silver just do something it has not done since 1980? Yes, on the screen, in nominal dollars, it printed a new high. But now you know the deeper truth, the one they buried. In real terms, in the value your money can actually command, silver has not touched its 1980 peak in more than 4 decades. And the record everyone is celebrating is a mirage sitting far below the true summit. The high they are showing you is not the high that matters. The real one is still up ahead. If you have stayed with me all the way to here, you are exactly the kind of person this last part is for. I hold a free one-on-one educational web conference for folks with $100,000 or more in a retirement account, people who watch to the end and mention that they did. It is not a sales pitch, and it is not an obligation. It is a conversation about how the pieces we just talked through might fit your specific situation. And let me give you the honest reason to do it now rather than someday. The right time to think clearly about protecting what you built is precisely when nothing feels urgent, when you can make a calm, unhurried decision instead of a panicked one. That window is open right now, in the quiet, before the crowd arrives. If you are watching on your television, scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. Come have the conversation while it is still early. Because the machinist who stood in line in 1980 learned the hard way that by the time everyone agrees, the easy part is already gone, and nobody sends you an invitation.